Welcome to Real Wealth, Real Health, the show that empowers you with insights, information, and inspiration to achieve your version of financial wellness. Learn how to balance living a full life today with planning for the future. This podcast is brought to you by Alpha Investing, a real estate-centric private capital network that provides exclusive investment opportunities to its members. And now, here are your hosts, Pier and Daniel Coca.
Hello and welcome back to another episode of Real Wealth, Real Health. This is Pier, and today we are having a conversation with Jillian Murrish. Jillian Murrish has broad experience in institutional investment as an entrepreneur and specifically in the financial technology industry and real estate crowdfunding. I am honored to call Jillian a close friend and one of the rising stars in the financial technology industry. Jillian is a co-founder and chief executive officer of Pier Asset Management. Prior to founding Pier, she was the executive vice president of capital markets at Patch of Land, one of the earliest real estate crowdfunding platforms, where she built one of the first institutional whole loan sales programs in the real estate marketplace lending industry. And before this, she worked with technology clients in the capital markets group at a leading middle market investment bank, Houlihan Lokey. With an eye for trends in the future of finance, she's paved a path of excellence and integrity throughout her career. Her knowledge and experience and her openness in sharing her story and insights are invaluable for our listeners and to anyone who seeks to understand a little more about the mechanics of finance and how this relates to their own goals and knowledge and education around building a healthy financial foundation. Hi, Jillian. Welcome to the podcast.
Hello. Great to be here.
I am so excited to have you on as one of our first guests, not only because I've known you for so many years, but truly because of the wealth of experience and inspiration and knowledge and just expertise that you have with like everything ranging from investing to real estate to all the alternative assets under the sun. So it might be a little hard for us to hone it in, but we're going to try because I want you to tell the world everything that you know. To get started, just to level set with everyone who's listening, tell us about yourself. Tell us especially about your professional background so that people can get to know you as the professional that you are.
Certainly. Well, thank you for that kind introduction. I will try to live up to your kind words. So, if looking back at, I guess if we start, you said on the professional side, I was a very young entrepreneur. So I started my career building a business around cell phone accessories. So we mainly focused on cell phone cases. I built that business and sold it, and that was really my first job was running my own company. And I left that and said, what's next? And what I realized my favorite part about that entrepreneurial venture was actually raising the capital for the business and then selling and negotiating the sale of the business. One of my mentors, for good or for not, recommended that investment banking was just that, raising capital, selling, buying businesses, etc. And so I joined at its infancy, the growth equity practice at Houlihan Lokey, a middle market investment bank. I joined the headquarters here in LA. We built that practice where we were fortunate enough to raise Series A's, B's, and C's for later stage technology companies. And it was really during my time in the capital markets practice at Houlihan that I really learned how to build businesses in a sustainable way. And then how do you build out headcount? How do you track expenses versus revenue? How does the venture world see these types of businesses? What metrics matter? Which founders built better businesses than others, right? What did it take to really build that big business? I got to see institutionally funded companies versus founder bootstrap funded companies, and I think that was where I started to shape my vision of how I thought it was best to build businesses. So after spending time there, I was itching to get back to the operator side, and I joined a fintech company in Los Angeles called Realty Mogul, and that firm was actually the first to do real estate equity crowdfunding, or I believe they claim to be one of the very early entrants in the space. And I got connected to them through one of the venture partners who had led their Series A. And it was there that I really started to explore the world of alternative investments, and but saw it through an interesting lens of how do we create financial products for the investor, right? And how are we thinking about what people want to invest in and why, and what impact does that have on people's lives? And so, during that time at Realty Mogul, I was very focused on equity investing in real estate. And I had a vision for a type of business that could be productive on the debt side of real estate crowdfunding. And I started doing research on that and came across a firm called Patch of Land, which actually that's where Adipia and I met. And I joined that firm actually because of you, and I think you know that. You were my tipping point. And it was an interesting business model where it was, similar to the consumer models of the world, like Lending Club and Prosper, but it was doing peer-to-peer online lending in the real estate space. And so I joined Patch of Land, relatively early on, and built the capital markets practice really from the ground up. When I had joined, the firm was focused on peer-to-peer lending, where it was $10,000, $20,000, $50,000 checks at a time that were gathered together to make one loan. And to scale the lending side of the business quicker, I built out the institutional backend. So I went and acquired our first warehouse lines, built out a whole loan sale program with behemoth billion-dollar credit funds purchasing loans in a forward flow manner from the business, which really helped accelerate the growth of that firm kind of in multiple magnitudes per year. So it was a blast. And there was really where I saw how the credit markets were working and what was efficient in the credit markets and really what wasn't. And it was during my time at Patch of Land that I came up with an idea for a way to invest capital in a way I thought was more efficient than what I was seeing out there at the time. And I saw that there were pockets in this alternative lending space that really lacked liquidity, which meant that if you could come in and bring capital to those places that lacked liquidity, you could make outpaced returns without having to increase the risk you were taking. And so I decided to leave Patch of Land to launch a fund where we would do that and act as a liquidity provider in the alternative lending space, and go in and buy pools of loans in the secondary market or provide warehouse lines to lenders. And we did just that. So I started my current company. It's called Pier Asset Management. That's PIER Asset Management. 2 years ago, or 2.5 years ago, actually. And time flies. And I've been building this business ever since. I teamed up with an incredible co-founder, Connor New, who was in the fund management space in the alternative lending vertical for a number of 5 to 7 years prior to starting this firm. And he had a really unique skill set in fund management, and I had a unique skill set by actually sitting on the operator side. And we teamed up and started this firm. And so that's what I'm doing today, is taking investor capital and then investing it in the credit sector.
Super interesting though. Really cool story. We always love to chat, with other entrepreneurs, and I think a lot of our investors are entrepreneurs too, so they can, kind of associate with all the things that you're saying. One thing that stuck out to me that I think might be interesting thing to comment on, is this idea that the movement rather to institutional capital and kind of what you felt necessitated that. Because, if you kind of look back to why crowdfunding exists and it kind of being a product of the Jobs Act of 2012, and the idea being that there are a lot of just average accredited investors who want to participate in these types of transactions that were previously either off limits to them or hard to find or unavailable for any kind of variety of reasons. And it seems like you guys started out, peer to peer with these individual investors, but then kind of quickly realized the larger capital that comes with the institutions kind of made more sense. And so I'd really just like to get your thoughts on that kind of progression as you've thought about it in that particular moment.
Sure. So I think at the time, the shift to bringing more institutional capital on board is really attractive from a growth standpoint. So it's the quickest way to scale revenue because you have to be offloading these loans somewhere. And if you're selling them to accredited investors, it just takes so many more individuals and so much more growth and expense to build that investor base than simply bringing on $1 billion credit fund that can fund 100% of your lending activity in a given year. And so being within the four walls of that firm patch of land, that was a very attractive route. I think if I go up 30,000 feet and look back down at that type of business model, I see a really interesting opportunity that can arise when you use institutional capital in a way to actually allow individual investors to diversify further than they would have been able to had you not had the institutional firepower behind you and behind that lending engine you have. So, for example, if you had $100 million worth of peer-to-peer kind of individual accredited investor demand for your lending product in 1 year, you could offer them $100 million worth of loans, say that's 1,000 loans. Well, if you have an institution that can increase that demand twofold, maybe you're having the institutions buy up half of individual loans, and then you can put twice as many loans out on your platform. So, by the time that I had left Patch of Land, we actually started using that model where we would use institutions to take out parts of loans and then fund the remainder with accredited investors. And it just allowed for much more diversification and more loan offerings that would have been possible without institutions. So if I look back at the shift from accredited to institutional capital and think about how I would do it differently next time or, focus harder in one area, I think it would be kind of marrying the two in a more tandem way than I think I did at the time. But there are businesses being built out there today that are doing and trying to focus, more on that because I do think that the accredited investor really has a lot of stability in our marketplace and can provide, longer time horizon capital. Be more flexible, do more of what I call make sense transactions, and they're not bound by credit facilities that a bank is putting on a big credit fund. And so I think, it is. I think everyone, people talk about it as that shift from accredited to institutional, and that certainly happened at many lenders. But I think that the platforms that tried to do it more in tandem or have it be a more symbiotic relationship, I think we're doing it right, in my view.
So I'm going to jump in here because I was just thinking about, because of course we work together, and when I started there, it was very much let's go for all the individuals, like go the peer-to-peer model, and seeing it evolve with you and allowing that to scale, which really works for debt because it's such a fast transaction and such a fast turnaround. Is that what you're seeing? And this is a little bit of a different question for you because you're doing different kind of credit transactions now, but I want to dig in a little bit into the credit side because you've become so passionate about it that you founded an entire firm on this. Does that work for your business as well? Or is the individual accredited investor doing make sense transactions. Do you see that only really working in, let's say, real estate crowdfunding, or is that also working in your space?
Oh, yes, that's a great question. So, in our space, it certainly is working. We span across consumer lending, small business lending, and real estate debt within the fund that we mostly operate here. And accredited investors are able to take part in that fund vehicle alongside large institutions like foundations and endowments. We have, multi-billion-dollar registered investment advisor, a wealth manager, who invests in the same vehicle that a dentist from Seattle, Washington, invests in. And so we very much adopted that model internally, where we can be using institutional capital alongside and with the exact same terms as accredited investors in our fund. So, I once again, I think in building businesses and how I think about building businesses, you want a very diversified base of customers and clients. And so when you're running a hedge fund or credit fund like myself, our clients are our investors. And having one or two really big clients, I don't think builds a very stable business. And, I would much rather have 200 clients that are diversified with different liquidity needs and different events happening in their lives than simply one or two clients that can go away and take your whole business with it. So that's my view there in terms of building successful businesses and accredited investors participating.
Right. And this is great because you actually pivoted into the question that I wanted to ask you. Just we're always on the same line of thought,
Yes.
which is like your biggest lessons and learnings about building businesses in the finance and the investment industry. Because as I've seen you develop and like grow your career and grow this company with Pier, you've taken bits and pieces from all the past things that you've done, and you're a small business like us, like Alpha Investing. We're small. We're not a big company running really high overhead or a ton of employees, but we do our volume, and you're doing a lot of volume with a small team. So I'm curious what you learned along the way that allowed you to do what you're doing in a small business way, but yet operating on big numbers.
Yes. So I think when I heard that question initially, I have a few trains of different thought. So I think the first one was the first train of thought I went down was, you have to know what you're an expert at and what you're not. And in the areas that you're not, you need to partner with folks who are. And so when I started this business, I knew I was an expert at understanding the way in which the alternative lending capital markets ecosystem fits together, and where are there gaps of lack of capital that I can put money in, structure it correctly, and get outpaced returns. That's what I know I'm an expert at. But I've never run a credit fund. I have not even worked at a hedge fund. Never once. So what did I do wanting to start this business? I went and found a partner where that is all he's done for the last 18 years. Like, that is it.
Right.
And so, he's literally been at a hedge fund or running his own credit fund for, I think it's 17 years, maybe 18. And so when you look at a bunch of these other businesses in the space, many of these fintech companies that started off and, some did well, some faltered. I think a big problem was that the founding team didn't understand or wasn't willing to understand their core competencies versus what that type of business needed. So, really having three technologists founding a alternative lending company, in my view, probably is not the most productive way to attack that. You should probably have one credit founder, one technologist, and then maybe one broader capital markets type finance person, or an expert at that specific asset class, right? So I think in building businesses, it's the team and understanding your core competencies or your gaps, and just building from there. There's a very attractive opportunity in this alternative asset space to build big businesses in terms of revenue, in terms of assets, in terms of volume of product, with a smaller, more nimble team. And if you can create repeatable processes, make everything efficient with technology, even as a finance shop, you can really cut down the number of back-end folks you need to be doing operations and processing. And with that, you can actually start out building a business that's profitable within the first few years, which is quite different than the venture capital backed model where you do need $5 or $10 million to pump into technology in the first year alone, right? A $5 or $10 million spend in 1 year to build that type of business. And you're constantly running against your time clock of when you run out of capital and when the next capital raise has to happen at the equity level of the operating company. And in my view, in building a business like that, there are certain spaces that certainly warrant that. So, for example, like consumer-facing apps where you need a network effect, like a Facebook or an Amazon, you have to have mass adoption for the business itself to actually work, right? If Facebook didn't have mass adoption, the business doesn't work at all. The beauty of this business model where you're managing capital and investing it in credit, or for you managing capital, putting it, helping people gain access to equity investments in real estate. The great thing is you can do 5 projects just as well as you can do 100 projects in 1 year, and your business works just the same as long as you scale your costs. And so, and there's a flip side to that, even actually, by keeping things smaller and tight, you may have a greater advantage. So I think it's a different business model, and the space that we both operate in lends itself to being lean and mean, and you can scale in a profitable manner and take that type of business model. Whereas if you're on Facebook or an Amazon, the mass adoption really does lend itself to needing to invest heavily in technology year after year and go into that fast venture-backed model, which, and going off on a tangent slightly, some of these peer-to-peer businesses, I think could have used a bit more of the profitable growth model that was left in the dust, which typically is what specialty finance companies operate as, right? You grow profitably with a focused core competency of what you're the best at. Whereas I think many of those tried to build as if they were a technology company only, and that led to some problems and some falling out of earlier platforms. But I think we're seeing staying power of those platforms that built on the right foundation. And for example, your business, right? Staying power built slower with your exact core focus of what your expertise is, and here you are rocking it. And other firms aren't, right? We've seen shakeout and fallout of other firms, I think because of that mismatch of the growth model.
Yeah. Yeah. And from our time together, because I was, I think employee number 1 at Land. And so, I'm that crazy cat that just says, okay, let's go for it. But, it's such a different, real estate is such a different business. It's not, in my opinion, right, a technology business. The beauty, though, of, let's say, crowdfunding from the tech perspective, because it has the legal perspective with the Jobs Act, and then it has the tech perspective of bringing things online. It really brought to the attention of the industry the need for streamlining and efficiencies and transparency because of both the consumer model and the technology that forced people, incumbents as well, because a lot of incumbent real estate firms as well, you've seen them like up their game with their marketing, with their websites. They have investor portals, but it's in service to the core business of real estate, as opposed to this idea that I drank that Kool-Aid in the beginning too, where I thought, yeah, let's do it. Technology is going to upend the real estate industry. And it's not.
I think I like the phrase tech enabled. Like we're enabling the real estate industry to perform better by, frankly, catching it up to the 21st century. Like you said, ancillary businesses, like servicing businesses who service real estate loans, many of them were run off of paper files until 5 years ago. I mean, that is wild, right? And I think a lot of it is clawing and bringing the real estate industry into our century, and then enabling and helping make the businesses more efficient. And I do think that one of the areas that, we're never going to replace humans, is the investing in the equity of commercial real estate properties. That is a bespoke skill set where you're analyzing very particular individual things and teaming up with humans and people who've been around and know that exact block corner of the city, and known the last 5 restaurants that cycled through that piece of real estate. Partnering with those experts, I think, is crucial and can't be replaced. And so, I think that leads to another topic actually of building businesses and how I view this finance investment firm space is that we really have to be particular about those that we partner with. And it goes down to understanding your expertise. And for me, myself, and in the way that we invest out of our fund, we go invest in lenders who have lent for 30 years in the real estate space. And that is the expert we go to, right? And I think synonymous on your end, you are going and working with sponsors who have put $100 million to work in one specific corner of a city. And they know exactly who's been in every building, who's coming in and doing the build out, et cetera. And I don't think that can be replaced with technology fully.
Right.
It can be enabled and made sharper.
Yes, exactly. Yeah, exactly. They know the ins and the outs. And what I've noticed too, with the sponsors is that they buy properties off market, and a lot of times they like fall into properties, let's say, because maybe they were like the third bidder and the first one fell out. And there's all of these, I don't know if you want to call them politics, but it's relationships, and it's it's being there. And it is, like you said, it's like one corner of one city is very different than another corner of another city. And so that kind of expertise, you can't replace it with technology, though you and I have both seen the data side.
No, we tried.
Right. Yeah, we tried. But, I think where the tech actually really helps everyone has been on the data side, just the amount and the transparency of data that's coming available. I mean, it costs a lot to have access to it, but it is there. And as cities take better data, and I'm talking about real estate now, and for your business, it's also it's all data driven on the consumer and business lending side. I mean, without those numbers, like, you're flying blind.
Yes. And for example, in consumer lending, when we're pricing out a portfolio here, we our chief investment officer will take 400 to 1,000 data points into account when analyzing and pricing up a loan. And that's consumer lending. The amount of data available is incredible. And yet it's a human brain creating the pricing model, looking at the portfolio overall, factoring in qualitative factors on top of quantitative factors, and then pricing out the correct price to purchase a portfolio. So that availability of data allows the human underwriting to be that much more sophisticated. I think you're right. And it's been incredible. I'm from House Canary to, I'm not sure the other platforms that you use for your real estate data, but I know there's a plethora.
Yeah, there's a lot, even like the basic like co-stars. And then if you're following, I really like to follow John Burns, who they focus more on the single family rental space, but that single family asset, because it is the substrate of American living, that data is really important, because we might be looking, let's say, at migration data for jobs, like people moving to different areas, and like, where are people going? There's these migration patterns, and like they're following the jobs, and the companies are following cheaper real estate to some degree. And it's like, it really is these interesting, like mini cycles, more like spirals, that the data tells a really interesting kind of story. But I personally find the single family data set really interesting, because it also ties into, well, behavioral economics and what is the consumer doing and how are they living. Even suburbs are completely being reimagined now. They're not what they used to be back in the 50s. People, there's a lot of, I don't know, like shade, if that's the right word, but, suburbs don't necessarily have the best connotation, but now suburbs are being developed out as like mini all encompassing communities so that people don't have to leave, because so many people can work from home now, and it's totally shifting the way that people are living in a city, who's living in a city, and the way the demographics are moving. Anyway, I think it's really fascinating.
Oh, well, we fully agree, and we have dashboards up in our office of many charts and data sets that feed into them, and are constantly using that type of information to make our investing decisions.
Well, yeah, because you're investing in loans that are basically people's like credit cards and business loans, and like that's driving so much of the economy. So like you have like really early indicators
Oh yeah.
on sentiment.
Oh yes, and it's critical that we stay on top of that. I mean, something interesting in the way that I view the credit space today is, or maybe this isn't interesting. I'd be curious to hear your thoughts on this, but the way that we've been analyzing the credit market is that we're certainly in later innings. I don't believe anyone would debate me on that. And because of that, the investing opportunity is some could say, oh, it's hold in cash. If you held in cash the last 5 or 6 years, you would have missed out on some of the best returns in the S&P 500. And you can't predict that. And people were saying even 5 years ago we were getting toward the tail end.
Yeah.
And so my view is it's incredibly difficult to time the bottom or the top. And so what do you do in these times? I say opportunity doesn't go away. I say it changes. And so the way that we've changed our investing activity at Pier is we look at shorter duration opportunities, and that's how we've decided to approach this timing in the market, or the time we are in the market cycle. And by doing that, we can be able to move to cash quickly to take advantage of illiquid assets when the downturn does occur. So that means for us, instead of investing in 10-year type of credit, we're investing in 12 months or 6 months. And I think it lends itself well to certain types of projects. And in the equity real estate space, I would be curious, what things you're seeing that are interesting and where you're focusing versus not, because during this time, like we said, the opportunity to invest does not go away. There are certainly ways to capture the market cycle and invest smart in equity real estate today, no doubt. And I'd be curious, are you guys focused on a certain sector lately, or is there something that is a theme you're capturing?
Yeah, no, yeah, definitely. We're really focused on multifamily. It still drives a lot of business, and it's still very much in demand. And a lot of that has to do with essentially the decreasing ability for people to buy the home that we were talking about, the single family home. And that phenomenon hasn't changed. So even though in the last like 5 years, banks have loosened up on the down payment amounts, right? For a while there, like it had to be 20% or you could not get a mortgage. Even though that's loosened up a little bit, there still is the issue of rising living costs, and the essentially, like, if your costs are so high, there's student loans involved, like, or there's all this credit that you know so well about, it's really hard for people to save money for a down payment, even if the down payment is 5%,
Yeah.
because price of everything is going up. So 5% of 200 5 years ago, but that now that property is going to go for 600. So you're getting further and further behind. And actually, that's one of the reasons that people are actually driving into smaller, sort of like even tertiary markets to buy a home, because it's the only place that they can afford to buy a home if they want one. So multifamily remains really strong. And we are looking mostly at Class B, some Class C, and I'm actually going to let Daniel jump in here with some of this stuff, because he's the one that works mostly with the sponsors. And the second category that we're super focused in is the senior living and assisted living care category.
Yeah, and so just come on top of what you just said, Aditya, I think there are larger macro trends that we find to hold true. And, as the market changes, we're always opportunistically, looking at different asset classes and different deal types and markets and what have you. But we circle back really to two common themes. One is that people are renting more than they're buying. They need places to live. And particularly coming into what many folks believe will be a recessionary environment, workforce housing in particular, is expected to remain strong during any type of recession-like environment, right? And then on the senior housing side, the population's aging, people are living longer, and we're still 6, 7, maybe 8 years out from baby boomers like formally entering assisted living facilities. And despite the fact that there's been a lot of development work going on in that asset class, we're still undersupplied. And particularly in the senior housing space, the types of projects that we like are the ones that are currently owned by the non-institutional investor, the mom and pop, right? It's a group that maybe has a 50 to 100 unit assisted living or memory care facility, and maybe they've owned it for 20, 30 years or so, and they really haven't put into place the institutional kind of management that some of these larger groups are able to do. And the trade-off is that there's just a lot of inefficiencies at that level. And so if we can come in, acquire something at a favorable basis with some upside that comes from better management, that maybe comes from the result of some interior renovations and upgrades, that comes from repositioning of the property in the marketplace, we think there are opportunities to kind of achieve that alpha that we're looking for.
Yeah. Great.
Yeah. So I want to spend the last few minutes on something that's near and dear to my heart, which is, financial empowerment. Probably why I started working in banking when I was 18. I had a pretty set in my mind that it was important.
Wow.
Yes. It's crazy. I just gave a new keynote, and I was telling the story about, I started when I was 18, and then when I was 38, I kind of hit what I felt like was like the pinnacle of this like financial career, before really jumping into this smaller business side, doing this with alpha investing. And it was kind of weird to think that that's already been 20 years. But anyway, so like my personal values, I know them. I have very strong personal values, not just on the financial empowerment, but also the people that I work with, hence alpha investing, hence like you and I are still in touch. Like, what are some of your personal values and goals, and how have they evolved throughout your career?
Ooh, I love this question. So when Connor and I set out to start Pier Asset Management, we sat down and started having, what I called were, co-founder, deep dives. And so we would talk through this. And that was what I decided was the most important factor in a co-founder outside of just, technical know-how. And so he fit the bill from a technical standpoint. But did we have those same principles and values to grow a business in a way that was harmonious to our work day, that flew, and flowed well into our home lives? And so when we set out to start this business, we put together a founding principles book that we wanted to live by and wanted our employees to live by. And really, they're very simple, and they developed over the course of my career. And I'm so grateful I had the opportunity to put them all in one cohesive kind of list and really try and stay true to that in this business venture, and picked them up along the way. I think I can list them off quickly. Number one is be good, and that's operate with social and environmental awareness. The other one is work with A quality talent. And this one we've touched on a bit during our talk, but the way that I like to define A quality talent, and what we look for here at Pier, is to work with a team of what we call smart creatives. It's a term that we took out of the book, How Google Works. Have either of you read that?
No, but it's on my list.
Yes, I must send you a copy. So
yes, please.
It's a fantastic book. And a smart creative is really defined It has a longer definition, but essentially it's someone who's not limited in their access to the company's information and computing power. They take risks. They're not punished or held back in any way when those risky initiatives fail. They speak up if they disagree with something. They get bored easily. They are multidimensional, combine tech depth with business knowledge and add a creative flair to it. They're not the knowledge workers that we see often, at least in the traditional sense. They're this smart creative that goes out into the world and sees things a bit as an entrepreneur, but with a foundational technical know-how that creates a really powerful employee contribution. So I see Connor that's my business partner, as in smart creative, and that's the team that we built here. So be good, A quality talent. Health is our third one, and that drills down to personal health. Automate is our fourth one. So we use technology to automate all repeatable processes within our business. So we are the most tech-forward fund that I know of, period. Like our head of operations codes in SQL. Like who's head of operations at a hedge fund codes?
Right.
And so we, that's once again in hiring and filling that role, that was a key tenet is automate. Transparency is our fifth. Profitability is sixth, and that's the last one. So, building a business where transparency is critical amongst our team, but also to our clients. As being in this business, you and I, that was one of the reasons we set out to build Patch of Land, was to create transparency to the accredited investor, that they could actually see and choose and pick what they were investing in, instead of going into this big financial engineered product that took down our financial system in 2008. And that was something that has stayed true in my heart to this day in building Pier, is building a business where we are fully transparent to our investors and then to our employees. We keep the doors open when we have meetings at our office. We don't have a kind of a bureaucratic or stratified type of work environment. Our most junior employee can speak casually and freely with me, our CEO, and we really try to foster that and push that. And then profitability was the last one I mentioned, and there is such strength in being profitable. That is the strongest seat you can be in as a business, in my view. There's so much strength in that, and building responsibly from there, and that gives you staying power. And in our business, we need to be around for a really long time for our clients. When they give us money, we need to invest it, care for it, grow it. And most people want to have a very long-term relationship with those that they're doing business with. So our clients want to be working with us in 20 years, and I want to be working with them in 20 years. And so profitability is that founding principle and just a key tenet of what we strive to maintain. I think those are the major values. And I think overarching that, and I don't have this in our founding principles, but it's something that I know you also believe in, is being highly selective with the external people we work with, right? We have just nurtured and been very slow to hire internally. And we've built this team that feels more like family than employees. And that has just been a stunning success. But you must be as equally protective as who you work with externally. And I think in my younger years in my career, I was much more focused on fast growth, and I would think to almost do a deal with anyone if the numbers made sense and they checked out with references. If they weren't even that nice of a person, it's a great deal. Right. Let's get it done. It's going to create wealth and prosperity, and it did. But it also created a really not fun work environment for a lot of people in doing those deals. It wasn't fun for me to work with that counterparty. Created a drag on the rest of my day, and I wouldn't be as present in the office with my employees, or I wouldn't be as sharp later in the day because it drained me having to have those calls with that external person who wasn't an A grade human. And so that's something it took me a long time to learn in my career. And I think you learned it, you had learned it by the time we started working together. And I think that was something that you helped teach me in our time working together, was we could be more selective. And I'm grateful that I get to sit in the seat I sit in today, owning my own business, owning the equity of this company, and not answering to other people with growth goals, and having to sacrifice on that principle of working with wonderful people externally as well, just for the sake of hitting internal numbers. We just don't.
Right. Oh, I love that. And you can hear it in your voice, like you can hear it in people's voices
Yes.
and in how they live. And we were talking about this before about how, in a way, it's a lifestyle business, but not maybe in like the Instagram way, but in like the true sense of the word. Like a lot of our investors are working professionals, like doctors and dentists and lawyers, and their work is not separate from themselves. And so this idea of the relationships being so important, because they are like they're form the foundation of your day, like transaction aside, it's who you work with, that energy has a huge impact on your life, how you feel, how you are when you go home. It's a huge principle. I see a lot more people shifting this way, and it makes me really happy, because I've always been a big believer in, like, yes, be a good person and work with good people and be aligned to your values. And when you align to your values, you will find other people who have
Oh,
aligned values.
I was just going to say that, Aditya. For me, it's been incredible over the last 2 years running this business, what comes to us now. Like the people that come to us and have come sought after our business, it's incredible, compared to, in previous iterations of my life where I had been, what flowed to me versus what flows to me now, just by waving the flag as the nice guys. We are the nice guys, and the nice guys want to work with the nice guys, and they come to us. It's built a really amazing ecosystem where, we invest in deals with other counterparties where, I'm proud to work with them and grateful. So it's, and caring about family, caring about these businesses, as you said. I don't like the idea of work-life balance. I like life. Like I choose to do this because I love it. I love coming to my office every morning. I like investing in these deals. I'm intellectually challenged. I absolutely adore our clients. We have incredible investors in our fund, and I love having those calls throughout the day. And so I really like to dispel the idea of work-life balance. And how do you manage it, Jillian? Is this, you run this, this business, and then you have your home life, and it must be really hard. How do you exercise? No, this is how we choose to spend our day and our time is our life. That's your life. Every part of it is not work and not life. It's just all life. And how do you want to build that? And what does that want? What do you want that to look like? And it's incredible when you meet other aligned people who have a similar view, and then your work becomes your life, and your life is your life, and it's all happy and good.
Isn't it crazy too how quickly that dynamic has kind of changed, right? I go back to 2010 when I'm coming out of law school, and I just think about the environment that I was in, at this New York City law firm, and just, how I felt about interacting with, the partners I worked for or clients, and just kind of what the demands were, right? And in a matter of really 10 years, and obviously we're a little bit of a self-selecting group here, right? But there really has been this massive shift in terms of, who people want to work with. And when I think about putting our team together, it's always this idea of like, we're hiring people to do a job, but we're a small team, and like we need that person to fill in other gaps and really just explore and be creative and find other ways to kind of help this business grow. And our thought has always been, this only makes sense, in a world where, everyone who's part of the team, feels comfortable kind of spreading their wings, for, lack of a better way of saying it.
Oh, yes. And the, over talked about, but just as equally important topic of it's okay to make mistakes. Whereas I remember in my investment banking days, probably very synonymous to your big law days, our law firm days, was the idea that making a mistake was the end of your career. Oh my goodness. So why would you try new things or take on bigger parts of the deal that you didn't know how to do really well? It didn't foster that type of spirit. Whereas I'm proud that inside our firm, and it sounds like inside of yours, employees ask to try new parts of our business. Our operations woman here, Sarah, who is what I call this incredible utility player. She can learn anything. And if I'm bandwidth constrained in a part of the business, she shadows and learns and then takes it on and may make a mistake or two, but actually Sarah really doesn't. She's not human, she's superhuman. But I know that she feels comfortable making a mistake, and that we're just thrilled that she's learning and trying a different area of the business. But it's important.
Yeah, I mean, a lot of what we're doing is new. And sometimes I forget that, right? People have been investing in real estate for forever, right? But there is no playbook for, accredited investors kind of getting into these types of institutional real estate deals. In the same way, there's no playbook for, the types of kind of credit deals that you're working on. We're writing it today. And so for us, it's always, it's not only, hey, like, you maybe want to consider working in a different part of the company. If you want to be a part of this team, like that's a prerequisite, right? Like, we want you to dip your toes into anything that, you feel comfortable with. And the reality is, things you don't feel comfortable with are areas for you to grow into. And the things that come out of that are kind of amazing, right? And like I said, there's not this playbook. And so, if you can come up with something that makes sense, that adds value, that we can standardize with technology over the course of time, like that's a huge win for us.
All right. Well, I want to be super respectful of your time, Jillian, because and I know that we could talk forever. So it's just been, guys, it's been such a pleasure to have you on the podcast, and over the past few years to, sort of have these parallel paths in our careers and to see you grow and thrive. It's just really beautiful to see, and I'm really happy for the growth of your business, because again, it's like these parallel paths. And so I just want to ask like one last question. If you have any tips or insights for investors who are not professionals in the space like you or like us, is there anything like parting words of wisdom about how they should be looking at or evaluating from a top line perspective, making new investments in a space like real estate or alternatives that is so different, so far removed from the common ETFs that they may be investing in?
Sure. So, the age-old wisdom that I actually remember my grandfather giving me when I was a girl was, try to make money while you're sleeping. And I think, fortunately for the accredited investor and, folks in a similar seat who have spare capital to invest, trying to find ways to make money has become easier than ever with opportunities like alpha investing or like Pier Asset Management. They can go and access alternative investments that aren't simply like a Goldman package credit product where there's 10 layers of fees and they don't know what's in it. And so I think it's critical to be getting into those types of investments that you can understand. And I guess that's my best piece of advice, is invest in things you can understand and you can learn to understand. And do it with trusted professionals who you align with, their values resonate with you, and really vet those counterparties. I say don't invest in something if you don't understand it. Take the time to learn it, listen to the webinars, read material on it, do follow-up calls with, people on the alpha investing team, for example, or, with people on the investor relations team at Pier Asset Management. And I just critically focus on that, because I think that's how we got into some of the issues we did in the financial crisis, was when we all invested in things we didn't understand. And then, diversify is another kind of cop-out answer to this, but I truly believe that. Invest in a variety of different projects and don't put all eggs in one basket, and work with different management teams, right? So, you can do all of your real estate investing in the equity portion through alpha investing. And then it's great that alpha investing doesn't pretend to understand stock investing. So go find a great stock manager and go put that portion of your portfolio with a different management team, right? That's another way to diversify.
Yeah.
So Um, diversify, and make money while you sleep.
Yeah. It's always back to the basics, isn't it?
Right? Keep it simple.
Yeah.
And I think I forgot that we were doing the podcast for a while. When you started your wrap-up moment here a few moments ago, I laughed when you said, "Thank you for being on the podcast." I said, "Oh, I thought we were catching up." But you are very good at running a podcast, because I forgot.
Oh, well, thank you. Well, we have to catch up personally, aside from this anyway, but for now, Jillian, thank you so much for being on the podcast, for sharing your wisdom and your knowledge, your insights, and really like your heart and your soul. It just comes through. So thank you so much again for being on the podcast.
Well, thank you for having me.
Thanks for tuning in to Real Wealth, Real Health. We hope that you've enjoyed today's episode and found it both informative and insightful. We welcome all your questions and your feedback about today's episode, and especially we welcome your questions about specific topics that you would like us to cover. So shoot us an email at podcast@alphai.com. And if you have a moment, we really appreciate ratings and reviews, as it helps us grow our online community and our interactions with you. And we'll also be linking to a number of relevant articles on topics that we might have touched on during our conversations. Some of them are broad, some of them are technical, but we're always aiming to provide information that helps you better understand the mechanics of building this healthy financial foundation, especially if you're looking to do this with real estate.